Hello, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor. And we have an interesting closing bell today with Price Headley of BigTrends.com. That'll begin at 4:30 p.m. Eastern. For now, I'm going to do my update, but I just want to tell you what this closing bell is about. It's going to be called My Favorite Technical Analysis Techniques. And Price is going to be utilizing his 25 plus years of trading experience and distilling that into a fast-paced 60-minute Cliff Notes summary of some of his top strategies that he uses to consistently produce results in today's volatile markets. So should definitely be interesting. He's going to be discussing various indicators that he uses, including Williams Percentage R, Commodities Channel Index, and other proprietary indicators such as acceleration bands that he has developed. And he's actually tested these techniques throughout time, and he's going to show you some case studies of recent winners and losers. So I'll be watching that with interest. And for now, let's take a look at what happened today in the market. So today, the market pulled back, at least the stock market pulled back, just typical or common end of quarter action. It was a fairly decent quarter. I mean, it could certainly have been worse, and it's common to see traders sell off or square away their positions at the end of the quarter. So you can see the market pull back a bit today, and that's not terribly surprising after such a surge yesterday. So right now, as I've been saying for the last few weeks, that we don't have a clear signal either way. The market is right now currently in a consolidation period. And 70% of the time, financial markets are not trending. They're going nowhere. They're basically going flat, just pretty much just trading in a random manner. So there's not always a real identifiable reason why the market did what it did, or basically why it's chopping around. A lot of it's just technical. Just traders just buying, selling, there's conflicting news. And 30% of the time, it's actually in a trend, and that's when we make our money as traders. So I'm watching for the next trend. And the S&P 500 right now is in that consolidation pattern. It seems like it's forming a wedge. I've been showing this rising up trend line. That should act as a support, and it actually has acted as a support several times. I want to see what it's going to do. Is it going to keep bouncing around within here? We're going to get a clear signal one of these days, maybe within a week or two, where it either breaks above or breaks below, which would be a bearish signal. So it's really just waiting for a catalyst. It could be Greece. It could be something related to a deal with Iran, which is supposed to happen by the end of today, to end sanctions on Iran. Some traders are speculating that that could cause oil prices to fall significantly, and who knows, it could boost risk assets like stocks. One second. Someone's saying they're unable to hear. You know, if you could just log out and log back in, that really should do the trick. All right, let me just see. Okay. Yeah, just log out and log back in. Sorry about that. All right, so it's whenever I see a consolidation, what goes through my mind is I try to look for the next possible catalyst. I try to look for a possible news event, a possible meeting, whether it's a Fed meeting, an ECB meeting, European Central Bank meeting, maybe Bank of Japan meeting, that has the potential to actually cause the markets to break out of their consolidation and start trending, because that'll tell us when we want to start looking for directional trades. Because this slop and chop, at least on a daily scale, is not really that profitable, but big moves like we saw back this past fall, or also that breakout that we saw back in February, are the most profitable, unless you're an options trader, and you can also profit from flat markets, which is nice. So maybe I'll discuss that in some webinars in the future. So let's take a look at the Dow. You can see it just forms similar patterns to the S&P 500. I still like to look at it, though, because each index is well watched. Many eyes are on it, and also they have their own subtle nuances. They all have their own unique support and resistance levels, as well as psychological levels, such as 18,000 in the Dow, which there are a lot of eyes around that. You can see pull back to its rising uptrend line. It's going to bounce around. That's my if you ask me for a prediction for the near future, it's going to bounce around until one of these supports or resistance levels is broken. And when it does, it'll start running again. Let's see. Lori's asking me what charting system I use for this report. For the sake of these updates, I use, I'm going to give you the link actually. They're called NetDania charts. And you can take a look and you can actually go through and look through yourself. I mean, when I do my own trading, I use the charting service that my own brokerage has, but I like these daily FX NetDania charts. I mean, I find them very convenient for the sake of doing these updates. I also look at stockcharts.com, but that's not real time. I like this because it's real time. You'll actually see it ticking before your eyes, and it's a free service. All right, let's take a look at the tech-heavy NASDAQ 100 now. See, same thing. Just looks like it's forming a wedge to me. That's most likely what it is doing. It seems like it's a very similar pattern to what we saw back here this past fall and early winter. So I want to see if it's going to bounce off that rising uptrend line. It can finally clear. All these indices I showed you, stock indices, need to clear their old highs. The ones that were made at the very beginning of this month on March 1st. So that's really the next hurdle that I'm watching. Let's look at Japan's Nikkei. You can see it's been in that channel I've been showing. And I said a few days ago, I said last week, I said I want to see how it's going to act at the top of this channel. Because when you see a market reach the top of a channel, it'll typically pull back to work off that overbought condition. So that's exactly what it did, pulled right back. So now I want to see, is it going to bounce from here? It could be a good long opportunity, or if it's actually going to break below and then there's going to be a follow through. So I'm watching this right now. And of course, let's say if there's a bullish trend where I'm interested in playing some sort of a bounce, I'm going to want to see a confirmation from in the form of similar action in U.S. stock indices. I like to see all these stocks move together. Whereas if I get a mixed signal, I'm definitely a lot more skeptical. And it goes back to the concept that is so crucial to me of confirmation. I'm always looking for markets, I'm looking for correlated markets. Even if they're inversely correlated, I want to make sure that they're telling me the same signal. All right, here we go. Now we are looking at the dollar. U.S. dollar index to be precise. And you can see it's in that channel, just up, down, up, down, up, down, all the way up. And we got that bounce that I was discussing last week. So you can see the dollar rebounded. Now it's gunning for its prior high, the high that it hit 2 weeks ago, right before Janet Yellen opened her mouth and caused dollar flash crash pretty much. Not last week, but the week before. So I want to see if it's going to try to reach its old high. At that point, I want to see if it's going to break above, and then if this bullish trend will continue. If it can't clear that old high, then it could pull back to this uptrend line. So just if you're following, and this applies to all correlated markets, meaning whether you're looking at non-U.S. currencies, you're looking at the dollar itself, or commodities like oil, or even oil stocks, or commodity stocks, you're going to want to know what the dollar is doing, because a rising dollar punishes those other assets. Commodity stocks do not do well in a rising dollar environment. And when you see, even though you may not care about what's happening in the Forex market, but let's say you're an intraday stock trader, turns out if you see a bullish trend in the dollar, chances are the next day in the Cyber Group room, you're going to be trading you're going to be shorting various commodity stocks or energy stocks. That's just how it works. That's why I think it's worthwhile to be aware, even if you're a day trader, just be aware of the broader macro trends, because it'll help you to find certain stocks that are likely to make big moves. Like let's say if you know that oil stocks are in play to the downside, chances are there's going to be some more downside momentum tomorrow. And we may want to start looking, when the market opens, you may want to start looking for downside opportunities right after it opens. Let's say if you know that the dollar's up. That's how I integrate trading and trading analysis. It's just looking at all the different markets and understanding those relationships. It's just so critical. All right, let's look at the euro now. Here we are. This sell-off is definitely accelerating. I was very skeptical of that rise in the euro. I really didn't feel like that was the bottom that we reached. You can see the euro bumped its head right at 110, key psychological level. You can see these wicks, the candle wicks, showed that it tried to close above four different times. It tried to close above 110, was unable to do it. That's a bearish sign. And then it proceeded to sell off. Also, it bumped its head right on that downtrend line, which is resistance. So you can see there are two resistance lines here, and that goes back to confirmation. I like to see multiple indicators telling me the same thing, multiple markets telling me the same thing. And I'm believe it or not, I'm actually going to be most likely very soon teaching a candlestick workshop for Cyber Group members. We're going to be ironing out the details, but I'm excited about that because it's a topic that I am a big fan of. I'm a huge believer in candlesticks, even though I haven't really discussed it in a lot of these free webinars, these updates. I love candlesticks. So I'm putting it all together, and I think you're going to be impressed. And I think you will find it's going to augment your trading, whether you're trading intraday stocks or you're trading futures as a swing trader, you're trading Forex. It works very nicely. So, all right, back to the euro. So now I'm seeing 1.05 as a likely target. It's probably going to try to gun for its old lows. Whenever you see markets make a move like this and then they reverse course, they try to reach their old highs and old lows. So that's typical. A typical trade is that it'll try to gun for its old lows, at least on the downside, and vice versa for the upside. All right, let's take a look. Because we have the closing bell, I'm not going to go over all the different Forex pairs. I'm just going to go over the major markets that a lot of people pay attention to. Let's take a look at West Texas Intermediate crude oil. This will be interesting in the next, probably in the next 8 hours or so, because there's likely going to be some sort of a deal with the United States and Iran, basically to end their, basically to cooperate and to end the sanctions that were placed by the, not just the United States, but the international community because of their nuclear program. And there's good reason to believe that if that does go through, Iran will then be able to export around 1 million barrels per day. And we already have a glut. There's a global oil glut. We have so much oil we don't even know what to do with. So now there's this prospect of Iran coming out with an additional 1 million barrels per day. So you can see oil's been pulling back a bit despite that, despite the geopolitical tension in Yemen. But some traders were saying, I think it was Barclays was saying that if Iran comes out, or basically if a deal is made with Iran, oil is going to fall $5 a barrel almost instantaneously. So I'm watching this trading range between $44 a barrel and $54 a barrel. I've been watching this for 3 months now. So I want to see, is there going to be a resolution? Is it going to break above and maybe create a double bottom, or is this just a pause before another move to the downside? I don't know. I don't predict, don't even bother to. Just react to these technical breakdowns and breakouts. So just keep your eyes on that, especially if you follow the Canadian dollar. That affects it. And also if you trade intraday, oil companies like Schlumberger or all sorts of oil service companies, NOV, National Oil Co. Varco. There's all sorts of, a lot of people in the Cyber Group trading room are trading energy companies basically on intraday, so it makes sense to pay attention to oil, I would say. Let's take a look at gold. Here we are. Still, you can see that channel was so important. It broke out from the channel, but it's been falling because the dollar has been rallying, and the dollar trades inversely with gold and other commodities, including oil. So if you want to know where gold and oil are heading, watch the dollar. Is the dollar's rally going to continue? If so, it's probably going to punish gold and oil. So you can see gold bumped its head right at 1200. And it goes back to the candlestick concept of a tall upper wick. See that? This was back on March 25th. Tried to rally above based on Yemen fears. Was unable to stay above that key psychological level of 1200, which acted as a resistance, and then pulled back. It's not too surprising. So, you folks have any questions for me at all? Let me know. Any markets you want to see? You want me to perform an analysis? We have a little bit of extra time. If you have any other questions for me, shoot me an email, Jesse at CTU Trading, and I'm going to be doing a lot more coaching very soon. So, one-on-one coaching on all sorts of markets, from Forex to swing trading stocks to investing, economics, futures, you name it. I'll teach you technical analysis. We'll customize coaching for you. So, shoot me an email if you're interested. All right, let's take a look at wheat. A lot of people want to see wheat. All right, let's take a look. One sec, I'm just pulling up another charting service. Unfortunately, the net Dania charts I show you here don't have wheat on it. Here we go. All right, so let's take a look at wheat. Right now, it looks like wheat is in a trading range. You can see it's been in this trading range since the start of February. And you can see the high is just under 550. And the low looks like it's just around 475. The prior trend was down, so I always look at the prior trend. I always want to know what the prior trend is doing, because it's so critical, or it likely indicates which way it's going to break once it breaks from the consolidation. Not always, but a good portion of the time, a trend in motion will stay in motion. So once a consolidation is over, it'll continue on in the same direction. But of course, it needs confirmation in the form of an actual solid close below that trading range or a close above. So I'll definitely take a look. Also, what is interesting is that the commercial hedgers, the smart money, see that green line? They have a slight long position. They're not aggressively long, but definitely worth noting, because they tend to be accurate. Whereas the dumb money, large traders in red are quite a bit... they've got somewhat of a short position, so... But I'm not seeing real trade set up at this point in wheat. All right. Let's see. Will the spiders continue moving down? Well, that goes back to, Michael, goes back to the chart I was showing you in the S&P 500. I was just showing that... I'll go back really quickly. As I said, I literally don't know. And I'm not saying this to be facetious. I'm saying this to be 100% honest. People who say that they know are lying. But I don't have to know in advance in order to call important moves. I just say I don't know before a breakout or breakdown. But I know the levels, and that's all I need to know. So I know that it's wedged between a support here, a support, rising up trend line support, and resistance overhead. So I know it's bouncing around, and I know that when it breaks one of these, it's likely to keep running. But I cannot tell you which way it's going to go in advance, nor do I have to. All right. Richard, you're interested in one-on-one. Wonderful. Okay. Yeah, just email me at Jesse at CTU Trading, and we can talk, and we can customize solutions. So I'm going to be doing this a lot more. It's been really popular with what Rich has been doing, and I'm going to be doing the same thing myself. So shoot me an email. Lita, would it make sense to buy U.S. dollars now for a trip to Canada in 2 weeks? Does it really make... You know what? For the amount of money that most people, unless you're taking hundreds of thousands of dollars, the amount of money, if it's just pocket change, what is it going to move? Maybe 1 or 2%? It's probably going to be negligible. And I wouldn't even deal with market timing when it comes to something like that. I would just say, just enjoy yourself. Do not concern yourself with Forex movements. Also, the underlying Forex market does not move a very high percentage. The only reason why Forex can be so profitable is because traders use leverage to lever up and amplify those moves. But the underlying moves do not move a very large amount. So, you're going to trade, $500, $1,000. What is it going to make a difference of 20, 30, $40? It's really just negligible, in my opinion. All right, so Price Headley will begin his presentation in about 10 minutes. So I'm going to leave you guys for now, and then hopefully we'll all enjoy this presentation. So talk to you soon. Take care, guys. Okay. Yeah. Should I pause the recording too?
Let's get started. Let me do a quick audio check. Can everybody hear me loud and clear? Perfect. All right, everybody. Let me just get the just let you know this is going to be recorded for your listening pleasure. And listen, I want to just kind of make a quick little intro for a personally very good friend of mine and loyal contributor to the trading education community. Has been around as long as I've been around. I mean, I know Price Headley for so many years, and it kind of gives you the insurance and of knowing that if he's still here and he's still teaching it, because what he's teaching is obviously makes perfect sense, and people learn a lot about it. And we've been having him on more and more at Cybertrade University because we've been getting a lot of requests about Price Headley because the content that he covers and talks about regarding about the futures and about the options, and he's no better guy that I know of regarding his technical analysis part of it. And here on Closing Bell, we always try to bring speakers, and if and with your guys' request, who you like more, we try to bring them back more and more than we can. And you've probably seen him around a lot. He's very, very well known in the industry. He does speakings for a lot of other presenters and brokerage firms and schools and stuff like that. And we're just happy to have him back. He's a good friend of mine from my small town in Kentucky. Still, hopefully, he's going to get me those tickets for the Kentucky Derby that's coming up. So I'm going to hold you up against that, Price Headley. So make sure you I know my wife wants to go down there also, so looking forward to that. But without saying, about the favors, everyone, listen, enjoy the presentation with Price Headley. Price, stage is all yours.
Well, thank you, Fausto. And yes, we're definitely going to have to do the Derby together real soon. And right now, the big ticket everybody's interested in here in Lexington, Kentucky is the ticket to the Final Four, as Kentucky Wildcats are trying to keep that perfect season alive. We'll see how that goes. They got a tough task against Wisconsin and whoever they play, if they play Monday night. So fingers crossed here, but let's do the Derby real soon. Yeah, good luck whichever team or teams you're rooting for. I'm excited to be with you all. It's always fun to be in Fausto's room here. Like Fausto said, gosh, we've known each other for a long time and both been trading for more than 25 years and teaching for more than 25 years. So it's a lot of fun to be with you. Without further ado, I'm going to jump in today and jump right into my top 3 favorite technical analysis techniques. Why not just one? Well, because one technique can give you a lot, but frankly, I like to filter things down to really the best of the best. I know a lot of people that say, "Oh, just trade price action." If I just traded price action, frankly, it wouldn't filter to what I consider to be the best and biggest trends to trade. So I'm going to share that with you today. Just a reminder, of course, that everything that we share with you today is for your information and education only, and nothing that I talk about should be considered a specific buy or sell recommendation. Ultimately, you know that you are solely responsible for your own investment decisions. And so do keep that in mind, and do check with your tax and financial advisor before you make any investment that might impact your unique tax and financial situation. Okay, now my job here today is to help point you in what I consider to be the right direction. I see a lot of folks that come to Big Trends, ever since I launched it back in '99, after doing a lot of trading myself from a lot of the '90s, basically, wanted to help teach people how to do this and take advantage of, the rolling moves into different sectors and different markets, and also the moves out of those markets too. So we'll show you both bull and bear examples today. But a lot of folks are still basically pointing in the wrong direction. So with education, you get pointed towards the target. That's how you can have your best shot to hit it. Then we'll talk at the end as I lay some groundwork for you here about how I explore for new opportunities in current markets in real time. And then it's ultimately about having really clear-cut entry and exit rules so you know how to pull the trigger to get in. More importantly, where you get out, how you manage the trade, how you manage your risk. Every trade involves risk, but it's all about risk management so you can really stay on the right side of the major trends and let the losing trades go quickly. You're not going to expect perfection in any trading method. If you do, Frank, I don't care how high you say your winning percentage is. I know folks that if they're shooting for perfection, they're in big trouble because perfectionists cannot let go of losing trades quickly and move on. You've got to learn how to do that. That's a big part of moving your capital into what's working and away from what's not working. Now, for me, I'm looking for trends that are showing acceleration. That is speed of movement. I like to, as Fausto mentioned, I like to trade not just stocks and ETFs and major market indexes, but I also like to trade in particular options on those. So I'm really looking for things that are going to be showing not just a slow, steady rate of gain potential, but really looking at things that are starting to accelerate or show almost a parabolic kind of an effect. When I got started, I graduated from Duke University, and that's why I give that little lecture on perfectionism, because I had some of it coming out of Duke with really high expectations for every trade I made that I thought should be a winner, right? We've all been there, and you think, well, I'm right and the market's wrong, and guess what? The market usually wins that battle. And so our job is to get in tune with that. But what I noticed, I was like a lot of you trading with moving averages and, testing all those moving averages. I was coming up with, frankly, far too many ideas, having pages of potential items I was watching. And guess what I did with pages of potential trades? Not much. A lot of times I froze because I was looking at way too many things. I needed to narrow my focus. So I was really looking for the best and biggest stocks up and down. And those best stocks don't come back to give you those tests of the major averages until it's too late, until those trends have already changed. So our job is to really get in tune with the biggest and best trends here. So I studied a lot of the various bands. You know about Bollinger Bands. John Bollinger had a great idea looking at standard deviation bands. But then I noticed that wasn't helping me really stay with the big trends. And so I was looking at Keltner channels and moving average envelopes and all kinds of other unique bands. But what I found is I stumbled across this idea of combining both volatility, that is standard deviation, and trends. You've got to factor in if something's flat, up, or down, and how much. And so factoring trends with that volatility gave me what I named acceleration bands. People told me I should have called it Headley bands. Maybe I should have, but I was really trying to get the point across to fellow traders of what we're after in this game, which is acceleration. And so, the bottom line is that, with acceleration bands, like a Bollinger Band, they're going to typically show you where the market should be trading the vast majority of the time, probably roughly 95% of the time. But you know what I want to trade? I want to actually trade the unusual other 5% of the time that's not supposed to be happening, believe it or not. Because you think, well, gee, isn't that going to basically come back against you and it's going to revert back down to the average? That's what, frankly, folks like the folks at Long-Term Capital Management believed, which had, the people who won the Nobel Prize for the options pricing model, and they promptly blew up that hedge fund in less than 2 years. They won the Nobel Prize for the options pricing model in '97. Long-term capital management blew up in the fall of '98. We're talking about, controlling trillions of dollars of asset values and blowing it up because they believed in reversion to the mean. Don't get me started there. We'll basically spend all day on some of the flaws in the options pricing model, but I believe you can take advantage of those flaws. And, it hit me when I was reading George Soros's quotes in a book called Soros on Soros, where he was being interviewed and talking about his successes. And he said, hey, it's the unexpected moves known as the fat tails of the distribution. They're not supposed to be happening. It's where he made the most money, like when he broke the Bank of England shorting the British pound for more than $1 billion. That's a billion with a B, $1 billion profit. Shorting the British pound. So with these concepts, I'll show you some history of how I launched big trends, and then we'll get into current charts. But basically, as I was starting to take advantage of bubbles, of frankly getting in as the bubble just starts to inflate. And here we got an acceleration band in red. Sometimes I change the colors around, but what I'm looking for is not just one little blip outside of that band. I want to see 2 straight closes on any time frame. I know we got a lot of quick traders in here. We'll look at some intraday charts before we're done. But after the 2 closes in a row, I buy the next bars open. And so this was CMGI. This was one of the stocks that really helped me put big trends on the map, in addition to calling the downside after September 2000 when the markets tanked into the Bush-Gore election and after that, and even into 9/11. We were bearish into that, and not once but twice in Barron's feature interviews said, watch out below. But bottom line is that, we were taking advantage of the inflation of the bubble on the way up. And in comparison to, say, other traditional bands, which are going to race to catch up, we'll look at some examples of that. This one will stay with it until we hit a trailing line as a stop that's not shown on here, but basically says get out of CMGI right at the end of 99. Right when everybody's worried about Y2K, and then they're saying, okay, Y2K is over, everything's all safe. Notice you have one above it right after the start of the new millennium, and then the second close was back underneath it. You would not be taking that trade because it only had one close outside there. See, one close can be noise. I look for two closes in a row in just about everything I do to tell me what's the true trend and to miss more of the noise. Let's get into the true breakouts. Let's avoid the fake outs. Okay, so the bottom line is you see then it chopped around. This stock eventually went to nothing because it was an internet venture fund. Did I care? No, because I was already out. As you see, the stock went from 65 to about 140 through that window there, more than a double in about 6 weeks. Not bad, right? And you say, oh, show me something new. We'll look at new in a second, but bottom line is, give me a little history. And the downside, 08 was one of our best years ever on the downside because of the downside collapses that were happening in the summer and fall of 08. Now, this one was an early precursor to that where we made money on Bear Stearns puts. By the way, it always intrigued me that they named the company Bear Stearns because guess what? It sure was bearish. Maybe they should have thought of calling it Bull Stearns. But regardless, you see that, Bear Stearns collapse, and you can see that the first attempted collapse, late 07, early 08, we're going to talk about this other line up here, the percent R line, in a second. But just even under the bands, you see the first band signal here would not have done much for you. You can see that it was trying to break down here, starting to go on the downside, and then it kind of edged back up. That's going to happen sometimes. That next percent R signal wouldn't have taken it because we're going to show you how we merge these indicators together. The last percent R signal, and then we get the 1 and the 2, the acceleration bands close, happened right behind the percent R from $69.94 down to $10, and actually it hit 3.5. And this was right before the weekend. Stock was trading at $30. Had a buddy of mine say, hey, I could buy the stock, sell some 30-strike calls with a week to go for $6. I could get a 20% return in a week. That's like 1,000% annualized. And I said, do not do that. Do not make that trade. He called me right before the close. The bell rang. He said, sorry, I just made the trade. Of course, he called me the next Monday when they announced JP Morgan said they're going to buy the stock for a measly $2 a share. Stock opened at 3.5. He lost 90% on the stock. That didn't offset the $6 back that he got on the cover call. So bottom line is, don't try to catch falling knives. In fact, take advantage of those on the downside. Now, I've been critiqued by others as saying, well, you're just trading bubbles. Isn't that riskier? My goal is to say, look, I would like to be on bubbles when they're just starting to get inflated, when they're in that strong acceleration phase. Those who miss out are usually the ones that talk down bubbles that put a negative connotation around the word bubble. I think bubbles can be a wonderful thing if you know how to get in early and then get out as it's just starting to come off of that peak. We're never going to try to catch the exact low and high, but our job is to really take advantage of that sweet spot as that thing is starting to go parabolic. Now, it also tells you when that bubble is bursting. So one of the big lessons is do not fall in love with any stock that you trade, any option trade you have, anything whatsoever. The key point is that stocks that can bubble up can also bubble down or burst down, right? You get that boom-bust cycle. So they can go down hard too. So frankly, it creates opportunity in both directions, and your job is to take advantage of both sides of that. And we help people do that at Big Trends, calling out trades, but teaching you how to find these too. A couple of quick lessons. Acceleration bands typically work best on the high growth sectors. Okay, so we're going to talk about some of those examples, like a little stock that I mentioned in my Big Trends community in the past week, a little biotech called Bluebird Bio, and it's been very good to me and my subscribers and students here just in the past few days, even when the market was acting kind of choppy. So biotech, technology, medical, health, communications usually is where you see a lot of opportunity because, let's face it, what's driving those? Typically, my number one fundamental that I look at is earnings growth. How fast is something growing, or when is the earnings starting to slip? You want to see what Wall Street's expectations are, but you want to see, can the stock keep eclipsing Wall Street's expectations? Because usually what will happen is a stock that's beating expectations will get more upgrades going forward because the analysts are usually slow to catch up. On the way down, the analysts barely trim their estimates but don't really catch up to the declining earnings in something that's rolling over quickly enough. So you get opportunities to stay in the direction of the earnings surprise, positive or negative. Also, you know what I like to see? Some kind of media debate about the company's prospects. I don't want everybody to agree that it's the greatest stock and it's going to be the next market leader. You know, I remember when Valero was breaking out back in '04 and '05, and I was on Fox News then saying, look, you know, Valero is a great one to buy. All three of the other panelists sitting with me around that table said, you're crazy, it's already run up too far, you're chasing it. Guess what? Valero more than doubled in both of those cases over the next 12 months or less. Same thing happened when I recommended Google right on the IPO on Fox News. All three said, you're just a nut buying into a overpriced tech stock. I said it's going to double in a year. It doubled in 3 months. So when everybody's doubting something that's really a potential opportunity, that's where you should get excited. If everybody agrees with me, it's usually not such a great idea. It's priced in at that point. So that's something I pay attention to also. So guess what? We're looking also at stocks that are breaking out to new highs. We're talking about stocks that are already at or near new highs. That seems very counterintuitive. I know a lot of people that say, no, I'd rather fish around on the 52-week lows list. Well, guess what? If you buy a dog, prepared to wake up with the fleas. Okay, the bottom line is you don't want to put yourself in a position where you're waiting and waiting and waiting and then wondering, gee, should I keep holding this? I like to get feedback fairly quickly that I'm on the right side. And if I'm wrong, I don't want to be wrong for very long. So, you know, especially in options, we need to roll those non-performers out and move on to the leaders, okay? So that's really a philosophy that has really launched big trends and helped thousands of fellow big trenders to take advantage of big market moves. Now, not everyone's going to work. We're going to show you ones that don't too, so I'm not claiming that every one of these does, but I'm saying, look, be focused on the setups that give you the opportunity for big gains, and then know how to control your risk. We're going to talk more about risk management. So look at Google here. Now, I've actually changed my colors around a little bit on this one. 1 and 2 bars outside the acceleration band in green, would tell us right there at that bar's closed or the next bar's open, you need to get a piece of Google there back when it was at about 550. Now, what you're noticing here is, look at, I've also plotted on here the Bollinger Band in red. And I get better on my colors as we go here with a little more differentiation, but past example. But bottom line is, look, what we're noticing is, look at how the Bollinger Band does not like for something to stay outside of it. And in contrast, the acceleration band in green here, you can see, is slowly climbing. So you can actually use these two indicators together. A lot of the big, had a question about the calculation on the acceleration bands. We give all that to you in a follow-up course. I'll tell you how you can get for a measly $99, how you can take advantage of what took me more than a decade to learn as I launch big trends. So bottom line is, we'll tell you about that later, and you can get many hours of training from me. You can watch again and again. But let me just tell you that you can get Bollinger Bands and acceleration bands on a lot of platforms, so you can start to plot them and play with them. I encourage you to get hands-on with this stuff to see what you're missing. See, so much in life, in terms of opportunity or in terms of risk, happens by what you're aware of, or frankly, what you're not aware of. If you're not aware of potential risks or potential things that are happening that you should be aware of, you might get burned. But if you know what you're looking for, you know how to control your risk, and you know, frankly, where to start getting your focus on the next big trends proper setup, to me, this is where you can really start to, frankly, completely change your profile of potential success, and also how you can better manage your risk. You can really improve your successes, and you can also, and frankly, stay with part of the position for bigger gains. I see too many traders these days who are way too gun shy. You're content to take a quick little winner, saying, well, I don't want a winner to turn into a loss, but then you end up giving up your upside, and then you end up taking losers that are overcoming the smaller winners. You don't want to do that. You want to take smaller losers and let your winners run, at least on part of your position. So that's a big part of what we teach, is how to take a partial profit and then trail your stop and give it a chance to run for these bigger opportunities. People say, well, look, the bands were pretty good at support down here. They looked at like resistance up here. Why not just trade the support resistance? You could do that if you did more, say, credit spreads or slower type of strategies. But here, where we're talking about buying an option, I don't want to get stuck on a slow boat when I want to be on a speed boat. So you want to be in there. You want to be out when that thing rolls over and hits underneath that trailing stop. Now, that's the first component. That kind of shows you the profile for things that are really in the launch mode and the takeoff. But then I start to use other tools that we can further manage not only how we want to tighten our stops, but also maybe where you might want to consider getting in if you're on the outside looking in. I know a lot of you have told me how many times you've missed a big trend up, and then you're on the outside going, well, now where do I buy? Well, I don't want to chase it. Well, gee, I've missed it. And then you look back later saying, wow, there's a lot more meat on the bone. There was a lot more opportunity there. I'll show you how you can take advantage of those opportunities and get back on the wagon with controlled risk. Percent R is one of the primary ways I do that. Now, Larry Williams developed this indicator. I'm a believer that, hey, I don't have to create every indicator that I'm looking at in order to take advantage of something that's got a positive edge to it. So with percent R, most people use it, in my opinion, the wrong way. A lot of people use it as a reversal indicator. The Williams approach actually goes from a range from 0 to minus 100. You'll see what I actually use is more of what I call the grade school scale from 0 to plus 100. That doesn't necessarily change the line's performance, although what does change is I use a longer setting. I gave you all the settings in the full course on the top 3 indicators that we'll talk about at the end. But bottom line is, for me, it's like how many of you have heard of the 80-20 rule? Most of you have heard of this, the Pareto principle, right? If you apply it to your trading, what does the 80-20 rule mean? Can anybody tell me with a quick chat? If you say 80-20 rule for trading, what does that basically imply? Pareto said that he noticed that European economists that 20% of the people controlled 80% of the wealth, right? So that was kind of, and by the way, you've heard of the 1%ers, right? That's even becoming more extreme where, you say then, of that, and then another 80-20 on that maybe 4% of the people are controlling even more of the wealth. Well, bottom line is, how would this apply to trading? If I tell you the 80-20 rule, it means that 20% of your trades are going to generate 80% of your profits. You say, how is that possible? There you go, Barry got it. You're in there first. You get the gold star today, Barry H. Bottom line is, the idea here is that when you're looking at this saying, okay, from this perspective, especially in options, if I'm buying an option, I know I'm going to get stopped on some trades because I keep fairly tight stops. And you might say, gee, I might even get stopped on half or even a little over half of my trades. You say, oh, I don't want to be in something that's doing less than a 50-50 win rate. And I say, but if you're making 3-1, 4-1, 5-1, if you can lose a point and make 10 points when you're right, or say $1,000 on a contract, you lose $100 when you're wrong. Say you lose $100 3 times. You're only winning 25% of the time, but you're making 1,000, you're losing 3 $100 bills, you'd be up $700 over 4 trades. You might be interested in that, okay? So the idea is, you don't have to have 80 or 90% win rates to be successful in trading, and in particular in option trading. We do have credit spread programs that have high winning percentages. There, we're worried about the 20% of the trades that could generate the vast majority, 80% or so of our losses, right? So if you do credit spreads, I know some of you like to do that for income, then you got to worry about those 20% of trades that aren't working, okay? So we're going to actually show you how to use percent R in a very different way, more of an extreme way. And in fact, you're going to see a lot of what I teach you is very unconventional. My belief is, if you're doing what everybody else is doing, you probably don't have that much of an edge. If you like to trade the traditional stochastics, RSI, MACD indicators, unless you use them in a really different way, trade moving averages like everybody else, guess what? You're going to get very mediocre or worse than mediocre results if you're doing what everybody else is doing. Let's not do that. Let's do something a little bit unconventional rather than the convention and take advantage of that. So the convention, you see, like in the normal percent R with the negative scale here, this is GE. You see it kind of goes back into like kind of this deeper range here and would kind of whipsaw you out if you were using it the way I like to use it, which is that, what I'm looking for here is overbought territory. And you know what? If it breaks down to overbought territory and then it never breaks that high, then sure, I would agree it's a trading range right there. Until it closes above that trading range, the next bar, it tells me, guess what? It's not a trading range anymore when it's making higher highs. The reason that the percent range can stay overbought for a long period of time is because something's making higher and higher highs, i.e. an uptrend, is basically telling you it's not a range anymore, it's a trend, right? Would you agree? I like something that's making higher highs and higher lows. I think you probably do too. And in fact, the reason I use a little different setting here is that when it does give us a pullback right here underneath the overbought area here, this is what I call a critical inflection point right there. That's a place where if you're already in this trade and you're still holding part of your position, you would reset your stop to say, if it closes under that key bar's low, I'm done with the trade. If it doesn't close under there going forward, I stay with it. But the other thing you can do, folks, I call this the retest, and this is a big part of what I teach through the more in-depth training. We'll show you some more examples of it today as well. I'll give you more of a taste of what you're missing. Is if you've been on the outside looking in, you're saying, I can't buy GE now. It's already run up some 10%. Geez, it's such a big name stock. There's no way it can keep going like that. Guess what happens? You see it has a big pop up and the continuation that keeps going. And you see then the next retest to set your stop on this one, the big trends way, is when it crosses underneath the overbought threshold right there on that dotted line there on the 22nd of Feb. And then in this case, it does violate the next day. So even if you were buying on that retest, you get stopped the next day. You wouldn't be wrong for but a day. One candle. This is a daily chart in this case. You can do this with hourly charts. You can do it with even shorter term charts. So you just need to know which ones are appropriate. But once it's done, I don't mess around with it. You can see this one just chopped around for the next few weeks. No thanks. We stay away from that. So what I'm showing you is that to improve your consistency, what I've found is that reducing whipsaws and the fake outs helps a lot. And the way that I do it is when it first starts to give me that attempted breakout, I don't buy there. I wait until it then follows through and closes past that key level. So a lot of traders buy on that first potential turn, that first what looks like a breakout. And then they get faked out. And I know a lot of you probably had this experience, haven't you, where you buy, maybe you've been waiting to buy, and then you say, okay, as soon as you buy, it's like the market knows that you just bought, and then it goes the other way. Do you ever feel like that in your trading? Yeah, we've all been there. You know, sometimes it feels like it's a conspiracy against us, right? But the bottom line is that it's not that. It's that maybe you were buying prematurely. Maybe you were just getting a little too excitable, like a lot of other people do. Guess what? Hey, we're all human. We've got to manage those tendencies that we all have. Lori says all the time, hey, I've been there too. And this was my solution to it, is to say, look, once we get the follow through, the best trends will have a lot more opportunity as long as you know that they're proving it to you. So I kind of say, prove it to me, stock. Prove it to me, market. Show me that you're ready to go by following through and confirming that initial setup point. So once you get that, there's often a lot more opportunity. And so, you know, our job is to say, okay, how can we get in on a breakout or on the next retest? Okay, so this is a chart of ICE, Intercontinental Exchange. You know, this stock did so well, it went on to say they're going to buy out the New York Stock Exchange because they were doing so well and the NYC wasn't doing much. And so guess what? They said, the stock's gone up a lot. We can afford to spend $8 billion or whatever they spent on the New York Stock Exchange. So guess what? If it worked for them, it can probably work for you too, to ride a hot stock. Okay, now, bottom line is, again, you see there's dead zones where this thing's stuck between the 20 and 80% range. And I say don't even mess with that. When it's just kind of coming off that oversold area, it may go back up. It may come down and give a bearish confirmation. We'll show you some bearish ones as well. But I say, look, when it's stuck in that dead zone, just stay away. Okay, so that's a first rule. Don't try to trade the same stock every day up or down. Some of the patterns will be up and some of them will be down. A lot of other stocks are trying to figure it out themselves. Those are stocks you don't want to mess with until they figure it out. Once the stock starts to kind of build some momentum up or down, then you want to get a piece of that momentum. If it has no momentum, you don't want to try to get in front of it and say, well, I think it's going to eventually have momentum. Maybe their earnings will make it move. Maybe they'll get an upgrade. Maybe there's some other thing coming out that'll happen. Let's skip the maybes and let's wait for the official confirmation. And again, it doesn't guarantee that you win on every trade, but it means that the setup is right, and then your job is to manage your risk. So one of the risk management tools I say is, look, when it went over bought here, and you can see in this case, the acceleration band's not going to come on board until a little bit later. What I always say is when you get a %R confirmation, which tends to hit first before even the band breakout, you can start to put a part of your capital in, but don't put it all in into that first signal. What I tend to say is you can put part of it in on a breakout, but save part of it for a retest, especially once you've had band confirmation. So you can put part of it in on that confirmation point there. You see the bands then start to trigger 1 and 2, and then we go through what we call the retest. Now the retest here is saying, look, it's coming out of that overbought mode, and that's a spot where I would say, look, I would then add my other half of my capital. We've had the acceleration band breakout, we've had the percent R, and now we're getting a percent R retest. That bar's low there in the middle of March is telling us that that low should hold on a future close, okay? I don't overreact to intrabar action, but you'll notice if you miss that one, ICE says, you know what, I'll give you another chance to get on the wagon here. And that next low is where you tighten your stop. Now you notice a couple bars later, it comes right back into it, trades below it, but does not, ever so close, but does not close below it. It closes right on or just a hair above it. And then it launches. So you know what's happening there in those little attempted breaks underneath that intraday? People are getting flushed out. That's the fake out of people that trail their stops too tightly intraday, and then boom, this thing turns and flips, and then bam, guess what I would do? I would say, take part of your money off the table into that upper acceleration band. Keep part of it for the longer trend. And of course, if I was buying an option, I would try to buy an in-the-money option. So say the stock's here at 75. I'm in there buying like the 70 strike calls in a case like that, and then cashing some of them out as it runs up. Then you can always buy back into it on the next retest. You see, this one gives multiple lines where it's showing you the retest. So these lows here are showing you multiple spots here. This thing keeps on saying retest, retest, retest. People ask me, how many retests before something finally violates? I mean, in this case, you can see it's given you 6. On the 7th one, it's going to violate. Now, does that mean 7 times you should never buy the 7th retest? No. It just means you don't know whether it's going to hold or break, but you know that if you're right about it holding, you get a wonderful low-risk entry. If you're wrong, you take a quick, smaller stop out. But look at what happens on this one. It reconfirms mid-May there. You break out. You fall through ever so slightly above that point right there. And then look, the very next bar there, about the 20th, it's retesting, giving a little fake out. The next bar after that, underneath, and then closing back above, and then you're off to the races. You tag the upper band, take some of that money off the table. So these are wonderful opportunities, upside or downside. This is Family Dollar. We jokingly have called it Fido at times when it has these downtrending phases for the retailer. It's going to have uptrending phases too. So again, don't permanently get negative on something just because its last trend was down. Stay flexible. But you can see for FDO, breaks down there on the first move and then closes underneath that, and you're starting that process. Oh, by the way, got an acceleration band confirmation, then gave a retest right behind it up there on that high. Okay, so there's a retest high right in there. Gives you a wonderful spot to add the other half of your position. So this is how we do this the big trends way. Now, eventually, you see it's going to violate. One of the other rules of thumb, folks, is that, look, on a big move like that where the stock went from about 30 bucks on down, you saw how it gapped down to 25 or less. On a windfall gap in your favor, you should be taking something off. Certainly, if you get a double on your option, you should be taking half of your profit at a double, no matter what. I don't care how much you love it. I don't care how many dollar signs are in your eyes, how much you think it's going to hundreds of percent or 1,000% or something like that. Take half of it off at a double. That's another good risk management rule, because what does that do? It gets all of your risk capital back in your pocket, taking half at a double. You bought something for $1,000, it's doubled to 2,000. You take half off, put that 1,000 of that too back in your pocket, and then you can give the rest of the trade a chance to run. You see in a case like this next one here where it's going to have this retest, and then in this case the violation is kind of brutal on the close. It's up at about $27. Sure, you put it on at 30, you're still making money, but you're kind of looking back going, gee, I wish I'd sold it down back when it had that gap down to 25. This selling half and then trying to then ride the rest takes it from being a black or white game, and it allows you to trade many shades of gray, not 50 shades, but bottom line is that a lot of different shades that you can take advantage of, and it frankly smooths you out as a trader. It doesn't make you ride the highs and lows. It allows you to really manage this, okay? You'll see, hey, look, it tried to go over bot right in here. Didn't confirm above that high. Good thing, right? Because then it shoots right back down. You stay away from the potential setup out of the bands for a bar, and then it flips. So that's why we don't just use one bar outside there. You get faked out on a number of trades. What do fake outs do for your, not just to your capital, but to your confidence? They chip away at it, right? The more fake outs you have, the more you're basically saying, geez, do I really want to trade this method anymore? You've all been there. I've been there. My job is to say, look, I'm in this game to build up not only my capital, but to preserve and continue building my confidence and my my financial and psychological capital so that I know I can weather short-term storms in the market. I know I can stay with it, this approach. Now, before I get into this, I want to show you some current charts, and we're going to come back and show you some of the other things you can do. Now, I got a lot on these charts here, so we're just going to kind of focus you on what I call my top three. Now, for example, okay, and you learn the top three, that gets you more than 80% of the way there. Then the other things are kind of fine-tuning, frankly, in my approach. Now, the reason I mentioned this little stock here, Bluebird, I'm not saying to do anything with it because right now I'm starting to hedge the gain that I have in it from the past few sessions. But this is a good example. You know, this is a stock that came up on my scans. I was doing some training for some students last week. And by the way, I always crack up when I hear that phrase that those who teach don't know and those who know don't teach, because I think it's completely wrong. What I find is by teaching fellow traders like yourself these methods, and I'm not holding back and saying you've got to, you know, wait to buy my course before I give you anything. I'm giving you lots of examples here, both past and current, to kind of encourage you to go look at this yourself too. But you do want to continue your training with additional education because it'll make you a better trader. What I find is by teaching other traders, it makes me a better trader. I'm sure Fausto's found the same thing. So the bottom line is I was teaching some traders. I was like, look, I was not on this first move on Bluebird Biotech because, frankly, this was teaching off of a longer-term scan of saying, look, this stock's been a mega leader here over the last year. You say, how can you possibly consider buying a stock like that here recently when it's had a big run already? A wise fellow trader who traded for a long time when I was coming to the game told me, how does this stock go from 1 to 100? I said, I don't know, very quickly or slowly. He said, no, it's got to go from 1 to 10 first. Okay, so stocks that go from 1 to 10 are proving to you that they have the potential to still keep going. You know, what's saying that this trend has to stop? And so what I was telling my students is when this stock pulled back with a little market pullback last week, when the market gave that pullback signal in the middle of last week, I told my students, I said, look, this one's giving us that classic low-risk retest, not just on these indicators I'm sharing with you today, but even on some other indicators that I share in more advanced training. So I line all these things up. I'm saying, look, we've been outside the bands. Now we're getting the retest, the percentile retest, the CCI, which is another tool I use to kind of further filter. If you're getting too many buy signals on a percentile breakout scan, I use CCI, the Commodity Channel Index, to further filter. I'm saying, look, that's still bullish too. We were outside the bands, now we're retracing. It's crunch time here, 110. And so I said, look, to my students, I said, look, I know that on a closing basis, and it's entirely possible the stock will retrace back there with a breakout area, which I said was around 106. You see the high was 106.23. I said, don't be surprised intraday, the next day, to see some retracement intraday back to that 106 breakout zone, but I'm going to be buying anything around 110 or lower the next morning. It opened at 108.5. You say, hold on, why are you buying below your stop? Because remember, my stop is on a closing basis. I've seen this happen so many times I can't count how many times I've seen it try to flip below the stop the next morning after you have 110 as your closing stop. End of day, end of bar, right? This is a daily chart. And I'm sitting on some nice gains on Bluebird. You see, right now, the one that I recommended to my students, the 100 call, I bought some myself as well. Bought 4 contracts when the stock was trading that next morning at 108.5. I bought the 100 calls, which, as you can see, had about $8.50 intrinsic, and I had to pay a few bucks above that, $11.70 average entry price. Say, whoa, that's an expensive option. I wanted to create what I call a stock substitute. These are, to me, much better choices to trade than the really speculative cheapies that are like lottery tickets. I don't want to trade. The lottery is a losing game, right? Somebody's going to win, but the millions of others are going to lose. So I'm looking for more consistency than that. So we buy in the money, and then I said, look for it to trade back near the old highs in the 124, 125 zone. The old high was 128, but you see a secondary high here, 124. So when it ran up yesterday morning, look at the high, 123.99. Today's high, 124.99. I was selling yesterday morning. I was selling some 125 calls, an average price of about 505 that I sold those 125 calls. That's called a debit spread. Now we're not here to teach you the ins and outs of every option strategy, but the idea is good low risk entry when it runs into resistance. Sure, I could have sold the 100 calls for about a double. Right now they're sitting on about a 90% gain, but then I sold the other ones against it, saying, hey, look, I still like the stock. It actually just went above and now back below to give me, or it almost went below today, around 120. Looks like support, but we're still waiting for the little initial retest to be official on that. So day to day it could bump around. But in the meantime, we're sitting on some nice gains that you can take to the bank. Even if you traded a contract, you'd be up over $1,000 on that one just off of just a few day pop up. You could take that and say thank you very much, go play somewhere else. But I'm saying, look, I think I can squeeze some more time out of it unless my next retest fails. Okay, that's not a current recommendation, mind you, because of course that was the time to buy it when it was giving that classic retest. When there's the old Rudyard Kipling poem called "If," right? A lot of you probably know that poem, and he basically says, if you can keep your head when everybody else is losing theirs, ... you'll be a man, my son. So the idea is you'll be much more mature, much more ahead of the crowd if you can take advantage of everybody else's mini panics. I call it the manic depressive market. They were loving the stock through here, and then boom, they're hating the stock after a couple days down, right? And so you get these swings back and forth. Your job is to take advantage of those. That's what retests give me the ability to do. Now, I'm going to show you scans here in just a minute, but for those that get time crunched, I do want to remind you that you can take advantage of this really fantastic opportunity to get my top 3 boot camp sessions. And bottom line is this includes all the %R settings, the acceleration band settings and rules, and the CCI settings and rules, my top 3 indicators that I like to use no matter what you trade. I'm showing you individual stocks because I think that's where you get more bang for your buck, but you can use this on the markets, you can use it on futures, you can use it on Forex. Pick your poison. We'll look at the dollar before we're done, for example, in the euro. But this is something, you go to that link, bigtrends.com/top3 bootcamp. I'll go to it at the end, but I just want to mention it in case you get where you have to get pulled away. Do not miss out on that because that's 2/3 off the normal price point, just $99 for 4.5 to 5 hours worth of training on all these key indicators. Let me get into the scans piece because like you, I'm always looking for new trades and saying, okay, here's how I do it. At least a starter, intro, quick start, if you will, on how I look at this. So I'm always looking for system opportunities. I've got fellow researchers that help me, but I always like doing the training for my fellow students. So bottom line is that these scans are taking what I've tested out over many, many years of data. And you say, well, how does this really test out? I mean, does this stuff really work? It's kind of fun to go in and look at some examples of that. Before I go in the scan, let me just show you a quick example of what I do in my testing. So bottom line is, here's a chart of the Dow monthly. Now, this is a super long-term trend chart. And this includes the %R buy signal, not even worrying about the retest. The retest would even help you get back on these sometimes at even better levels. You can see the last buy we had going over bought at the end of 2010. You say, why didn't we buy the low? Well, because we were bearish on the short, was went oversold from 10,847. We went down more than 4,000 points on the Dow over those 5 months from the short that started in October of 08, at the very beginning of October. That was right as the free fall was starting for the markets there. Now, the buy happened there. Remember, we had that panic in the summer of 2011 where the ratings agencies downgraded U.S. debt, and so the people started selling off stocks in the market and bonds, saying, "Oh, that's terrible for the market." And so look what happened. We go this little retracement here underneath that overbought zone there, right at the short-term low. Dow was 10,600 on the low, and you see how it briefly undercut it to 10.4 at the beginning of October, and that was the strongest reversal, the best month in the market, October of 2011, since January of 1987. So basically, 24 years later, it had its best 1 month gain. Why? Because it's coming right off that retracement. You can see off of these retests, as I call them, the turn and flip can be very sharp, very quick on a lot of time frames. We actually had that retest this past October, intra-month, but it flipped back up by the close. So if you're paying attention, same thing happened here in January. We were testing right down into that level at the end of January, beginning of February, then boom, the quick flip. Now we're kind of settling back down here this month of March. You can see things have pulled back a little bit. Has this trend broken? Of course not. So people that are wringing their hands about that the market's getting pounded here over the last couple of sessions aren't looking at the long-term chart. Right now, the long-term chart says we're still in an uptrend. And yes, you want to be taking some profits as you move up. Right now, I have a target up into this roughly 18.5 area. You saw we got to 18.244. I think we'll make new highs before this pattern is done. 18.5, 18.6 would be my target on the Dow. But the point I want to make to you is one of the cool things within TradeStation here is on the Dow, I can actually go back 90 years back. Okay, I can look back across 9 decades of data. And so that takes you back all the way into the roaring 20s. And actually it doesn't even count that roaring 20s buy with the retest in 1927, the monster parabolic move outside the acceleration bands into, of course, eventually, sure, every trend's got to end, but that everybody talks about what a great time that was, right? And then people assume that when you look at the October 29 market crash, people assume that that's where the Great Depression started. I disagree. Just a quick little tidbit on history. If you look at this chart, where did the sell actually happen? You see, we're actually giving what we call a retest right there, and we were bouncing, and you say, yeah, but it was such damage, right? It looked like we were breaking below the trailing moving averages. Yes, that's true, but when we went oversold and then broke down, with the Dow at a whopping 205.92 is where the sell signal happens. So we're going oversold and continue to break down. As the Dow went from 205 down to its century low at 40.5, right? That's an 80% haircut in the Dow from the fall of 1930, a year after the Black Monday crash of 29. And bottom line is that you say, geez, from that October 29 crash, it was the follow-through that happened a year later and then lasted for almost 2 years is where people got disgusted and frankly said this thing is completely collapsing. That's where people gave up on stocks and said, you know, that's where everybody tightened up. Frankly, probably a lot of people would have been so disgusted with the market at that point, they probably would have missed the next setup buy signal here at Dow 104. Shocking, isn't it? Dow 104 on its way to a near double up to 195 in 1935 and 1936. And so the point here is that stay flexible. And the reason I mentioned that 29 didn't start off the Great Depression until the follow through in 1930. Look at the 87 crash. There's your 80s parabolic up move. There's your crash, October 87. That's a retest, and that low at 1616 is not taken out. And then we bounce back to the new highs and further new highs over the next couple of years. Brief violation with the Saddam Hussein invasion of Kuwait. And then you see a little choppy, you'd wait, and then after Saddam was, on the first time, rooted out, but not officially rooted out, but people felt relieved enough that we got a buy signal there at the Dow at 3,027 on its way to a more than triple throughout the 90s. Gave the exit here at 10,416 before. Like I said in Barron's, watch out below in fall of 2000. As this thing ended, we got the correction, and then, of course, the next buy early 04. So the point of this is, so what? Well, if you look back in history then at how this strategy's performed, not just across bull markets, but also across bear markets, check this out. And again, this is not don't look at the dollar figure because those would technically not be, you couldn't make dollars on the Dow Industrials. You can trade the DIA, you can't trade the Dow Industrials. Okay, so but bottom line is look at the direction is what we care about. And in particular, the win percentages, even on shorts over a 9-decade overall bull market, you see it doesn't give a lot of shorts and frankly even a lot of longs. This is a very long-term system. But these size of average win to size of average loss, even on the shorts, 8-1, and on the longs, 24-1. That means if you lose $100 on a loser, you make $2,400 on a winner. I mean, that's insane, the size of those win-to-loss ratios, frankly. And that just shows you how powerful these percentile methodologies can be to where you get these really steady and uptrending equity curves. And, of course, the Dow being points-based, those last signals have even gotten probably more weight. But the bottom line is even the older signals have been very effective. So bottom line is this stuff works both short-term and long-term. It's pretty powerful. And so let's talk about scans now. I'm running a little tight on time, so again, I could talk to you all day about market history. But what I like to do for you shorter-term traders You see I've got a 15-minute interval here, but usually what I would say is start with the daily, work down to the hourly, and then you can come back to the 15 minutes. So let's just do daily first. So what we're looking for here, when we look at, say, %R, this is in TradeStation. You don't have to have TradeStation to take advantage of this. But yeah, Ron, it does work really nicely on weekly and daily as well as the short-term charts, and it works for stocks, ETFs, options, etc. It does. I've been very pleased with it. Not everyone works, but it works for smaller losses and bigger potential wins. Okay, that's what we're in the game for. So the idea is if I look at the daily scans here, you see a stock like Target. The yellow means it was going over bought, but that's just a setup. The green means it confirmed. Notice the market was down 200 points today. It was confirmed yesterday, and Target actually gained another 31 cents today on the stock when the market was down. That is huge outperformance. Okay? Now, some of these that go green yesterday, like Skyworks Solutions, then went red today. Red is not bad. It means that it's a retest. Okay, so Skyworks today showing a potential retest. Same thing for Electronic Arts. Now, I'm not telling you to buy these. I'm just saying these are how I start to build my watch list. So EA and SWKS would be bull retest candidates. So would PAN-W. That's Palo Alto Networks, one that I've been talking about for quite a while as well. So when you go in and you look at these, for example, let's look at Palo Alto for a sec. And you say, okay, you pick it up on your scan, then all you got to do is click the symbol, and it'll pop it up across whatever time frames you want to look at. Now, I really like to get all three time frames lined up in the same direction. While the daily's on a buy right here, frankly, the intraday charts are not quite where they need to be. So, back before on Palo Alto, when you go back to some of these prior phases when the stock was rallying, on the daily, the hourly, and the 15-minute, I call that triple confirmation. That's where you can really get all the rivers of time flowing in your favor. That makes, in my experience, for an even higher quality trade. But, you go in and you look at some of these and you say, okay, I mentioned SWKS, for example. You say, okay, again, intraday, it's not going to look that great yet because we're just on a bull retest. We got to wait and see what happens with these intraday charts on this one before we would be willing to buy that right now. Now, of course, this stock got added to the S&P not long ago. If you were catching it during that phase, again, look at once the daily's on a buy. People always ask me, well, how do I get back on board when this daily chart's running away from me? Well, if you look at the hourly chart, you say, well, there's my hourly. The daily's backing me up. There's my 15-minute. Bam, nice trend day. Next time the hourly comes on board, we're waiting for the 15-minute. Bam, nice little trend day. So you can take advantage of that even for you short-term traders that are just going in and out the same day by looking at the daily's bullish, the hourly's bullish. Now the 15 comes on board. Thank you very much. Take it from 89.5 to 91 that day. There's just a lot of potential, whatever type of a trader you are. So, the bottom line is that, again, before you go, make sure you do check out that link. Let me just post it because I don't want people to miss out on it. I'll type it in here for some folks at Carol that have to go. It's bigtrends.com/top 3 boot camp. Okay, so just check that out and you can take advantage of it. But I got a lot more I want to share with you. Now, I'm not a perma bull here. We want to take advantage of bull and bear. So when we go do the bear scan on the daily, and we're going to go into the intraday scans in a sec, you resort for those, and these are the ones that are at the bottom of the pile. These are the laggards. Chipotle just broke down yesterday. Guess what? More downside today. LinkedIn's already been broken here, and it's been breaking over the last few days, obviously. You look at MasterCard, surprisingly, just broke down today. MasterCard, I've talked about how the credit card companies seem like they're just a license to print money. They're just taking that 2.5% or 3% out of merchants, it seems like a pretty good business unless the economy is going way south and they've got a lot of potential default risk. I don't really see that being a problem. So fundamentally, I might be a little bit more wary of that one because I think that that's a pretty solid business. But SanDisk, this stock broke down recently. So let's look at SanDisk for a second. Had a big gap down a few days ago, SNDK. So here's an example where you're seeing, okay, there's your downside break on the daily. You're seeing that your 15 minutes just giving your confirmation. It's waiting to pull the hourly, and the hourly's been on a sell since right before the gap. So, again, getting all three lined up, you'd say, yeah, I think SanDisk has more downside potential. Then I go look at the options and see how the options are shaping up. You can even do this when you look at an options chart. How do you look at an options chart? Well, if I'm typing in or you pull it off of a chain, say you're looking at the April options, The 65 puts are probably a little too risky for me, but I'll look at the chart anyway just to see how that option is moving. The option chart shows you who's winning the battle between trend and time. Too many of you have had the experience where you buy an option, you think that the chart looks really good on the stock, and then the option doesn't move. You might even be right on the stock, and you still don't make any money, or worse yet, you lose a bit of money on the option because maybe you bought the option wrong. You bought it too high. You bought it when the volatility was a little too juiced. You bought it right in front of an event, and then you got a gap risk situation. So, we want to be careful in those situations, but we would say, right now, yeah, it's not in probably the ideal profile on the 15-minute chart, but the hourly still looks pretty good on it. So we would pay attention to this, but frankly, it does look like it's not quite fast enough. I'd like to see not just some percent R here, but also CCI, these tools confirming that this put option is breaking out more over this 320 level on a follow through. So we'll see if that happens tomorrow or not. It may not. I'm not buying that here. I'm saying it's a watch. It's not an action item yet. So we go through all those scans. We can even do that on the acceleration bands. Go back to the scan for a second. Say, look, if we want to go pick up, show me which acceleration bands ones are really moving. So we got an acceleration band scan here. I can say, show me what's above the upper one. More than one means, you know what? The only thing that's above there on the daily chart is FXI. That's the China ETF. Those have been going ballistic here recently, right? And so it got the big breakout yesterday, and then you see it's kind of settled today. Still not bad given that, it had that retracement this morning. Percent R would say that's a retest. Even the 15-minute showed that was a retest. So you could have been buying that dip this morning on FXI when it was retesting here at 44.06, and that would be your key number. You got a nice little snapback here intraday off of that, where it's up about 1% on the ETF. Obviously, with an option, you could do even better. So, and that's in a down market day. Let's look at the S&P for a second. If you're looking at the SPDR, for example, talking about the big index ETFs here, we've got a lot of other tools we teach here, but bottom line is that you can see technically we just had a bear retest yesterday on the daily chart. The reason I'm not that bearish yet, even though short term is looking a little bit dicey on the 15-minute follow through at the end of the day, is that we're above the longer term trend line. So if you go back and you look, if you're trying to take a short back in the January period while this thing was kind of chopping or edging down, trying to take this short signal, I didn't take it because we're still above the long-term trend line. So the bottom line is that these shorts have not been good. That's very typical. You want to line up your short-term signals with your longer-term trends. The more you line those things in the same direction, the more powerful you're going to find that your indicator is. So again, when I lined up, even when everybody's panicking on that blue stock, if you came in late, and I said, look, I was buying this Bluebird Biotech, I hadn't even really followed it until I picked it up on a scan. A lot of the biotechs have been strong. This one in particular was showing that retracement. So buying into that dip, buying, and this one's not a super active option, but just let's look at the option chart for a second. So if you see the 100 call that I was buying for starters last week, right as it opened, you can see opened at 12. I was starting to buy there. I was edging down towards 11.5. And edged my contracts in, averaged at 11.70. So I was in there off the open to just right after the open, buying my 4 contracts, saying thank you very much, and then we get the nice snap up here, 22 over the last few days. But the bottom line is, from this perspective, and I didn't sell those, I just sold some calls against it here yesterday morning. So the bottom line is that while we can do a variety of strategies, that entry is so critical. And then if I was wrong, if it had closed underneath that 110 level for the stock, I was done, out, moving on to the next trade. So, the bottom line here is that when you factor in how you can take advantage of this stuff, to me, the logical way to take advantage of it is you need to first train yourself on the best, smartest way to take advantage of this stuff. So let me just show you real quickly. What I do is I go in here and I say, okay, let me go learn about these techniques by teaching you through the top 3 boot camp. Now, the top 3 boot camp is in depth. I mean, it is going through all the kind of questions that we get. And so from this perspective, what you'll see here is that with the top 3 indicators, the percent R course alone, the first of the 3 sessions on percent R down here at the bottom, went for more than 2 hours. Because not only was I training the things that I know about percent R for the last 15 years, the big trends way, the unique way. Not just, you can't just go search for teach me about percent R on a generic web page and learn how to trade this. In fact, it will probably teach you the wrong way to trade it, in my opinion. There's a lot of ways to trade all kinds of indicators. This is the one that's allowed me to stay with a lot of trends and find those low-risk retest points. You can hop back on a trend that you've been missing out on. And so that's really important. The acceleration band shows you how to confirm that percent R move with the stocks that are really blasting off. You know, think about a space shuttle launch. You better have enough power and force and energy to get that thing off of the ground, away from the Earth's gravity, so that thing can coast on its own momentum later. Same principle with acceleration bands. And then the extra filter with commodity channel index, not just on stock charts, but also on option charts. This package that I'm making available to you today as a member of Fausto's group usually was $2.99 to our Big Trends base. I just recently recorded it. And the bottom line is I'm making it available to you for 2/3 off, just 99 bucks. This will give you lifetime access to the high definition sessions. You also get a dedicated email where you can then email in questions if you've got any questions from the roughly 5 hours of material that I'm giving you access to here today for just 99 bucks. So what you do here to take advantage of it is you go to that page, Top 3 Boot Camp, and then you go ahead and hit the Add to Cart button, and bottom line is you'll see that it'll pop up this page about how you go ahead and get signed up here. So it's popping it up right now in the shopping cart, 99 bucks. No taxes unless you're in the state of Kentucky. No shipping because it's delivered to you through instant on-demand access. You get a dedicated email, dedicated login, and password, and then that gives you your access to go ahead and start taking advantage of all the ins and outs, the tips and tricks I've learned using these indicators from my trading career. Frankly, it's like giving you a shortcut to all that knowledge, saving you countless hours, countless money that frankly, you know, when I was getting started, yeah, I paid the price. I made some mistakes, but now you learn how to not make those mistakes and take advantage of it. So you just hit the green checkout button right under the price point there. You'll see the green checkout button, and you'll notice on there we take all of your major credit cards. So all these bold fields are what's needed to get your credit card processed. We also take PayPal. All your big credit cards, get that information in. You're on the secure page there. And we don't keep credit cards at Big Trends. We use a national and international provider of payment systems with one shopping cart. So basically, very secure. And bottom line is you can just say either I assisted you or you saw it through the webinar, either way. And if you have any questions, of course, we're always here to help answer your questions. We spell out all the terms and conditions. You want to read that because it's educational content. It's available to you for a lifetime, but you know, frankly, once you've watched it, you've had access to it. So bottom line is I know you're going to find it's well worth every dollar, the 99 bucks you invest in yourself. For the rest of your trading life, you're getting knowledge that frankly it took me many, many years to learn that I share with my premium Big Trend students here. So you're going to definitely have your eyes open here. Just check on the terms and conditions box, hit the submit order, and you get that special login code so you can start taking advantage of the material. And then if you have questions, you get the dedicated email to ask questions of me and my research team anytime there's anything on your mind from the material. Now let me just see real quickly, and again, that page is bigtrends.com/top3 bootcamp. So you see here, got it listed there. I'm going to just copy it over one time for you here. And so, yeah, if you have any questions, let's see, is it making sense? We had the question about if you were wondering about, does it work for currencies? Does it work for Forex? Yeah, I mean, take a look at the dollar, UUP. This is the dollar ETF. Check this out. I mean, you think about, you know, the big moves in currencies that we've had. Well, look at what it's been telling you about the dollar for, 9 months. It's been telling you big time breakout, not just outside the bands, outside of percent R, CCI confirming, big move from July into October. Caught the next move, wasn't quite as big on that next one, November to mid-December, but then the big move that just ended from right before the Christmas holiday to just ended here this past week. Now it's in that no man's land. It's chopping around. Tracy says most indicators are lagging, or the ones that I use more time current. Yeah, absolutely, Tracy. I mean, the bottom line is that they may be coincident. They're not going to necessarily be leading, because guess what? I don't want to be leading and hoping for a move to develop that doesn't move. I want to be in tune with the move that's developing right here. I'm never going to be catching the exact low and exact high. Frankly, if you play that game, If you try to catch exact lows and exact highs, I think you're setting yourself up for big problems. I would much rather see you learn the retest method on %R for starters for that low-risk entry and how to hop back on a trend that's in motion and you catch the next big wave up. If you like to trade Apple, Apple is another great example where, when it catches that big breakout after the earnings, I'm in there after the earnings. I'm not worried about the gap on the earnings. I'm taking advantage of those big moves after. Didn't take that recent short attempt on %R because it's frankly stuck in between the bands and it's above the long-term trend line. So you can use this stuff on so many different stocks and markets, and then even on stocks that are happening intraday. Even though a stock like Baidu has been dead on the daily chart, we've been in and out of Baidu a couple of times with long and short, catching that wave up, taking advantage of that big surge in the stock on the way up, and you see on the way down too. So you can trade the big momentum stocks both directions. Alex says indicators work on NinjaTrader. I've had some people tell me they've coded it in NinjaTrader. We don't have an entire toolkit for that, but yeah, you can probably pick some stuff up there as you learn it first. I get worried about you trying to do it yourself without knowing the various ins and outs and then making mistakes that you could, frankly, for $99, save yourself a lot of time and potential trading risk in your own trading by getting properly trained. All right, I'm past my time. I appreciate Fausto hosting me and the rest of the group. Always great to see you all at Cyber Trading University. CTU does a great job. Thanks, Jesse, as well. So basically, make sure you get to that link. It's bigtrends.com/top3 bootcamp. We'll post it one more time for you in case you missed it earlier. And it's in for TradeStation, it's in for Thinkorswim, it's in for Metastock. So it's in for those big three, and then you can find some of the indicators on some of the other big platforms as well. But get the trading first. You can see for just $99, you can more than make that up on not just one trade, but even just a portion of a trade real quickly and have that information for life. This is lifetime access, HD quality videos, high definition quality, on demand. As many times as you want to watch it, there are no limitations. Once you buy it, it's yours. All I ask is that you use it for your own personal use and don't go sharing it around because you have problems if you do that. So basically, just know it's for your use, for you and your family's benefit. You can share this with your family, but nobody else. So thanks so much. Appreciate it, Denise. Thanks, Fausto, and everybody else. Trade them well. Have a great evening, and looking forward to another great day of trading tomorrow. Remember, of course, the markets close on Friday with the Good Friday holiday. So those of you that are trading weeklies know that Thursday this week is your last day of this week's weeklies. Keep that in mind. Have a happy Easter, and definitely hope to see you all real soon. Take care, trade them well, and